Hi, good evening. My name is Arya Suresh, and this is my viva where I will be defending the three COF questions I completed for the FIN332 final exam. For COF question 1, my report focuses on the impact of the ongoing geopolitical tensions in the Middle East and how they influence oil prices and in turn stock performance, particularly for ExxonMobil and S&P 500 index. The idea behind this is that such events create uncertainty in oil supply, which leads to price shocks and potential trading opportunities. To analyze this, I used an event study methodology over a long term dataset while focusing on short event windows around each geopolitical shock. I calculated daily returns for both Exxon and the S&P 500 index and then used the Kappa model to estimate expected returns. Abnormal returns were derived by subtracting expected returns from actual returns, and cumulative abnormal returns were used to observe whether these effects persisted over time. Based on this, I developed a trading strategy where positions were taken during or immediately after the geopolitical event and held for a short period of time. The findings showed consistently positive abnormal returns for Exxon during these periods, even when the broader market performed poorly, indicating that the strategy was effective. I also analyzed risk using an adjusted kappa model with dummy variables to capture event periods. The result suggested that the stock's behavior changes during these events, reflecting increased sensitivity to oil price movements and higher market uncertainty. In conclusion, the study highlights that financial markets do not always adjust instantly to new information, which creates short term inefficiencies that can be exploited through event driven trading strategies. Financial assets are traded across different market structures, including order driven markets, where prices are determined by supply and demand, and code driven markets, where markers provide liquidity. For the second COP question, I focused on equity and options markets, which are highly liquid and allow strategies like covered calls to be implemented effectively. I evaluated how trades are executed by considering factors such as price movements, strike prices, and option premiums. This helped in understanding how timing, liquidity, and pricing affect trade outcomes in real markets. The question involved constructing a trading portfolio using 5 stocks and 2 indices and applying a buy right strategy across 12 stimulated trades. I compared equity returns with buy right returns and found that while the strategy provides consistent premium income and improves risk adjusted performance, it limits upside gains in strongly bullish markets. In terms of performance evaluation, the strategy showed positive overall returns with reduced volatility, demonstrating its effectiveness in stable market conditions. Although the report was completely individual, my teammates and I engaged in group discussions where we shared our perspectives and insights, reflecting collaborative decision making similar to real life financial market environments. In conclusion, the study concludes that the buy right strategy modifies the risk return profile of investments but does not conclusively violate the efficient market hypothesis. For COF 3, I constructed a diversified portfolio of 5 bonds, including government securities issued by the US Treasury, along with corporate bonds from companies such as Johnson& Johnson, Netflix, and the Ford Motor Company. The data collected included each bond's yield to maturity, coupon rate, and time to maturity, which allowed me to assess both return and risk characteristics. I then calculated the portfolio's Macaulay duration by taking the weighted average of each individual bond's duration, providing an estimate of sensitivity to interest rate changes. This was further converted into modified duration to measure how much the bond portfolio value would change for a 1% movement in interest rates. Convexity was also analyzed by applying a 1% increase and decrease in yields and recalculating bond prices. This helped capture the curvature in price yield relationship and improve the accuracy of the risk assessment. The results indicate that the portfolio has a moderate duration, suggesting balanced interest rate risk, while convexity varies across bonds. Overall, the portfolio is positioned to benefit from potential rate cuts later in 2026 while maintaining stability in a volatile environment. Thank you.